This video continues our discussion on journal entries and the use of debits and credits. We're going to use the example that we had used in class last Thursday, where we talked about how our assets equals our liability plus equity. I think you guys may recall this screen. So let's talk about it in regards to how does that translate to journal entries, which are expressed in debits and credits. So as you recall, our first transaction was that an individual contributed money to a company in exchange for common stock. So what we can do here is that we can first set up our journal entries. So a couple things about it. The debits are always on the left, credits are on the right. So as you recall, they contributed $100,000. It increased our cash and assets by $100,000, and it increased our equity in the form of capital, of common stock, by $100,000. So as you recall from the previous video, to increase an asset, we debit it. So let's take the first thing, cash. So we know cash is an asset. So to increase an asset, we debit it. So there's our $100,000 in cash. Now the opposite side of that was that what also happened was that equity went up in the form of capital, in the form of common stock. And to increase an equity, we credit it. And thus, debits equals credit. In fact, that is the golden rule. Debits must always, always, always equal credits. Now, moving on in our example, what happened next was that the company went out and obtained more cash. So they got some more assets. In fact, they went out to a bank and signed a note for $50,000. So now what happens is that assets went up by $50,000, and as you recall, liabilities also went up in the form of a notes payable by $50,000. The next transaction that happened was that they took some of their money and acquired a piece of equipment. So what happened in that? Well, one asset went up, equipment, another one down, cash. So what we're going to do is that we're going to debit equipment because that asset went up by $5,000. And cash went down by $5,000. Thus we're going to credit it. As you recall, the next transaction that happened was that the company went out, performed services worth $1,000, and was paid in cash for those services. So as you recall, assets went up by $1,000 because they have now $1,000 more cash. And as you recall, the equity side of the equation also went up, because revenue went up and which caused retained earnings to go up. And to increase that side of the equation, you credit it. Then the company went and paid some wages in cash. So now here's an example where even though I write the debit, it has to be listed first, like this example, I don't necessarily have to write it first. So I know that cash decreased by $200 in our example. So I'm going to credit cash, $200. And what happened was that the equity side went down in the form of an expense, which will eventually reduce retained earnings too. So I'm going to debit wage expense because, again, to decrease the equity side, you debit it. The next transaction that occurred was that the company paid for some fuel on account. So on account means accounts payable. So in this scenario, the liabilities went up. To increase a liability, you credit it. And in this case, the retained earnings went down because we incurred an expense in the sense of fuel. Okay. Now moving on over here, we're going to set up our same debit and credit. And I believe the next transaction that occurred was that the company went out and performed some more services on account. Okay, so when they perform services on an account, they expect a customer to pay in a certain amount of time. That is an accounts receivable, or otherwise known as an AR. And since AR is an asset, to increase an asset, we debit it. And as you recall from our example, what also happened in that transaction was that the equity side went up because revenue was earned. And to increase in equity, you credit it. Then that customer made a partial payment of the $3,000. In fact, they paid $300. So what happens? Well, one asset went up, cash, by $300, but another one went down, accounts receivable, because they no longer owe you $300. Yes, they still owe you another $2,700, but they owe you $300 less. The next transaction that occurred was that the company recognized that it had some wage expense that it did not pay for. Okay. So wage expense, any expense for that matter, will decrease your capital, will decrease your retained earnings and thus decrease your equity. And to decrease something on the right side of the equation, the liability and equity side, you debit it. Again, to decrease an equity, you debit it. So in our case, I believe it was $500. And since it didn't pay it, we recognize that it's a payable. We increase the liability because now we owe some money. And to increase the liability, you credit it. The last transaction was that the company paid dividends, paid a cash dividend. So it decreased cash by $800. And it also decreased retained earnings because it paid out some of its retained earnings. Thus, we debit it because to decrease in equity, we debit it. This ends our example of using journal entries to express the transactions that we did in class.